there is only one thing which is really common among all those successful traders around the world, which is interviewed in that book, is being disciplined with their respective trading system. So winning streaks does more damage than losing streaks.
Rule-based trading is ultimately discretionary because the manager still has to decide what markets to trade, how much risk to trade.
Like you guys make this sound so easy, right? Like you make this sound like system trading is, anybody can do it. So my first question to you guys is, and any of you can start here, that what role does discipline play in becoming a profitable trader, right? What is the role of discipline in this, uh, in a trader's
Yeah,
journey?
right. So definitely discipline is one of the key important factors with respect to trading. Like, for an example, if you read the book, the Market Wizards by Jack Swagger back in 1980s itself, it is about a book of compilation of multiple interviews of best traders in the world. But if you study that book, each of those best traders out there would be completely different from each other. Like they would be, following different strategies. One guy would be following charts. The other guy would be saying the charts might not work, but the fundamental part would be working. So each of these traders are successful, but the kind of systems or by the kind of strategies they use are completely different. But if there is only one thing which is really common among all those successful traders around the world, which is interviewed in that book, is being disciplined with their respective trading system. So no matter what kind of trading system they use, they are very disciplined with their approach. So that clearly shows that no matter what kind of strategies we use to be a successful trader, discipline really plays an own important factor. And also, people say it's all about how we react when something goes wrong, when some trade goes against you. How you react determines your success. But no, in my perspective, it is all about how you react when everything goes in your favor. Like no, you're making profits, trading trade after trade, week after week. So when everything is in profits and when you're on a continuous winning streaks, that is when the devil comes. So that is when you think like, no, okay, you are able to crack the markets, you're able to get the holy grail in the markets. Somehow you feel that you are at the top of the markets, and that is when you start now tend to ignore all the warning signs. And that is because of all those winning streaks that gives you back to back. You tend to think that you know about everything about markets, and you bet big in just one single trade, and you lose everything in just one single trade. So winning streaks does more damage than losing streaks. So we definitely can't remove emotions. We can only manage to a certain extent, but the one who manages it become more disciplined, and the one who becomes disciplined eventually become a profitable trader. So definitely discipline plays a vital role in every trader's life.
Yeah, absolutely. To just take on, to add on to what Kiru is saying, I was actually reading an interview of a trader who was in the army and like who moved into trading. Right? And the army is something where obviously discipline is ingrained. So like they would naturally have a. And this guy actually said that I was not as scared, even in the, and not to scare anyone in a good way, that in the war I was not as scared as in trading at times. And the reason is in the war I knew who my enemy is. In trading, I'm kind of still trying to figure out. So like Kiru said, I think that the streaks where you tend to win, and it happens with everyone, right? As traders, we win, lose, and there'll be phases. If it gets to your head, that's where the problem starts, right? Because the market is it's actually a transfer of money, they say, from the undisciplined or indisciplined to discipline. So discipline is the bedrock of trading. It is the bedrock, absolutely. Not a cliche word or something. It is the very reason why we would perhaps exist and live as traders.
No, I totally agree with you guys here. Discipline is the most important aspect of trading. Uh, Now, both of you guys work as rule based traders, right? Systematic traders, algo traders. So, I wanted to understand, how does discipline come into the rule based trading framework, right? How does the rule based trading framework help you become more disciplined? And talking about rule based trading framework, how different is it from a discretionary trader, right? Naive trader. So, if you can throw
So,
some light on that, yeah.
so two
Sure,
fantastic
sure.
sets of questions, Sonam, and because you are practicing this as well the full time, so you would really, we can relate to this.
Yeah, yeah.
So the first part about how rule-based trading helps in building a discipline is one of the biggest struggles in the initial years, and which I still partly do when I trade without a complete system, right? So like I'll trade say in and out, and I do a very small portion of my trading still on that. My biggest challenge was to actually stick with the winners and cut the losers. So right, like so basically when I'm having a loss, I would tend to sometimes hold on, not and sometimes hold on longer than normal and think it's going to come back. Ye upar aa jayega, the liberty of a little bit of English here. It's going to come back, right? And when I'm making money, I would tend to book earlier because I'm like, jo mil raha hai le lo, right? Just take it. I want to minimize my loss and things. And when I read Market Wizards, actually, I came across this interview by Ed Sykota, which all of us would know, and many wouldn't know him as much as like how we know the Warren Buffett in investing. Ed is actually probably the equivalent or bigger, more in the trading world, just purely because of his wisdom and the record. And many of these legends, wizards, right, they all were facing the same issues. Right? And basically, the rule based trading helped them to deal with it. Like Kiru said, you cannot remove emotion from trading, but you can. Rule based trading helps to channelize that at the core where you cut loss and you ride a winner. And it's absolutely core, even from the economics we have learned. David Ricardo, apparently, or Adam, so they say that cut your losses and ride your winner. That's at the core. That's the first core thing I would say. Kiru?
Yes, man. So, with respect to how a rule-based trading helps me to become disciplined, is like consider any sportsman or athletes. Like, no, everybody knows like Usain Bolt. No, everybody knows Michael Phelps. No, we know back-to-back Olympian champions. But if you observe closely, like the major success part comes because they are very disciplined with their training approach. So, starting from diet, starting from training, everything they follow a scheduled process. It's not just 1 day or 2 day. It's a prolonged process. Which is guided by professionals and trainers. They just follow the process. They don't focus on the outcome at all. So when there is a process, definitely there will be a progress. So that is exactly what rule based trading is all about. So it is just a process. We just need to follow the process, which helps you to stay disciplined. So because it tells you, okay, this is when you need to buy, this is when you need to exit, this is how much quantity you need to buy. So when every single rules is clear cut told to you, you don't get to panic. So most people take wrong decisions because the first question they ask is how much I'm going to make in this trade, not how much I'm going to lose in this trade. If they've asked
Right.
how much I'm going to lose in this trade, definitely they would have been much prepared when something goes against them. But everybody
Right.
thinks that okay, this is how much I'm going to make, and eventually they start trading and they lose big. But rule-based trading is all about just a clear-cut process, which helps you to stay disciplined because you just have to focus on the process, and eventually that is going to lead you to a progress. So that is why rule-based trading gives you more, helps you to be more disciplined than a discretionary trader.
Definitely.
And just to
So
answer
that
your
that
the second part which you said about discretionary versus rule based, the difference.
Yeah, discretionary versus rule based. Yeah, what I would say is discretionary trading is all about, it's about you, like how you feel about the markets, how you feel currently, because it's all comes to only you. It's you who decide when to buy. It's you who decide. No, it's all about you who is going to make the decisions. So it is all about when you are not in a current state of mind which you couldn't make decisions, it affects you internally. And also you don't have a clear cut process with respect to discretionary trading. It is based on the number of screen time that you spend with respect to the markets or whatever that you have observed recently. Based on that, you take decisions. So there could be anything that could go wrong when it comes to discretionary trading. Whereas with rule-based trading, it's not about you. It's about the markets. It's about the data. You just need to be a follower of the data. So it greatly helps being a rule-based trader to be a disciplined guy than a discretionary trader.
So over
right.
the years, I've been having like different take about this, and this is a debatable topic. It's like the melody, chocolatey, and 50-50 thing. And Ed said this, right, and a lot of things he says is like we keep learning after years. That there's so much wisdom. He said rule-based trading is ultimately discretionary because the manager still has to decide what markets to trade, how much risk to trade, and when to increase or decrease the equity as a function of the curve. So there is discretion, but not probably day-to-day decision about आज क्या लगता है ऊपर जाएगा नीचे आएगा तो मैं ये करूँ, right? Like it's about then once you've decided you're following a set of rules, you kind of then keep following. And that's the
No, yeah, no, I definitely agree with you, Vivek, here that even a rule-based trader has to have a discretionary element. And yeah, all of us are irrational, right? So we don't, I know I don't take the best trading decisions, but I can rely on a system to do better than what I can do. Uh, so now that we have discussed what rule-based trading is, how do you think our users can get started on rule-based trading and how they can create a trading system? How you guys got started? If you can throw some lights on that. Yeah.
Yeah, sure. Now, with respect to creating a trading system, most people start with the system directly. They'll say, "Okay, I wanted to create a short strategy, and let me start applying the strategy every single day." But instead of that, if they could observe the markets, for an example, consider weekly options. The weekly options was introduced in 2016 from June onwards. So we have almost last 4 to 5 years of 7 years of data, like how the market has behaved on every single expiry day. So people can see, like, take every Thursdays and see how the movement is from open to high and open to close, like whatever the ranges that you wanted to check. People can observe, okay, this is how Thursdays looks like versus other days. And this is how Thursdays looks like between 2016 to 2022, before 2016, like before the weekly options. So definitely
Right.
there is a huge deviation. The Thursdays movements are now becoming narrower, and statistically, the number of days where the market stays in range bound are much higher on Thursdays. So it states that though, no, even though there could be 1 or 2 days or few days of volatile movement on Thursdays, but if we could focus on creating a strategy that could make money out of range bound days, on specifically applying on expiry days, then it would end up giving us a positive returns. Then you can just apply it and then test it out. Probably use certain exit parameters. Say, suppose if the market is trending, we need to cut the losses and come out. So you can create a short straddle or strangle strategy with the fixed stop losses on Thursdays and try to test it out and then see if the results are good and then go ahead and deploy it. So instead of directly coming up with a strangle or straddle, observe the market behavior and how it is done, specifically if you're an option seller on expiry days, and accordingly create a strategy. So that is the best starting point to get started with rule-based trading.
Yeah, thankfully, nowadays with the amount of information available freely, right, in terms of strategies, people sharing their experiences about ideas and tools, it's significantly better than I think the way back, at least when I started. It looks like a long time now at times, but it's probably in 2012 when the first time I came across a system called Ninja Trader, where we got data from eSignal, is a software. We picked up 1 minute stock prices data, loaded into Ninja, and turned a idea like which I was trading a breakout system. Right? So I'd basically trade when price breaks out of a band, I would buy, and when it goes below, I would sell. And I didn't have the skill to do that deeply, so collaborated with another trader who is a chartered market technician. Right, he got the idea. I had a little bit of systems background, and we built this. But like you said, it's not just about the strategy because there are so many strategies available. If you apply it, and if you don't have conviction in that idea or that process, it's usually very difficult to stick with it. Then the drawdown comes. Drawdown is where strategy is going to go through a losing phase, and everything eventually will at some point. If it's not even worse, because your biggest drawdown is ahead if you actually, so that drawdown will come.
Right.
So in nowadays, thankfully, so you take an idea, right, and try to use and maybe tweak it a little to make your own. And I think we might talk about it a little later as well. And the other is there are great tools available like for options backtesting, especially like you were saying today, which a lot of you must be, I think, either using as the option traders. So there's things like stockmark.in is a fantastic tool where you can backtest. And now there's algotest.in. Like these are some great tools where you can backtest ideas and see how it did in the past, and then you get an idea of what it's likely to do in the future. Right? And I just think among the so many benefits of system trading, one key thing which we miss is the advantage of bet size control, right? So like when you lose say half or 1% of your capital on the trade on average. And most
Right.
wizards have said in their books that when you lose less, and you lose just 1% of your capital, then you, even if have 5 or 10 losers, you're still in the game. Right? So that's another
Right.
great advantage of systematic trading.
No, definitely. No, so yeah, so that brings me to my next question, right? Like you guys make this sound so easy, right? Like you make this sound like system trading is, uh, you know, uh, anybody can do it, but obviously there are challenges that come across the way, right? Somebody starting their journey with an algo will face a number of things that before they make a successful algo, right? So how do you think you can evaluate a trading system? What are the parameters that you look at when you're trying to build a system? And
So like in
Yeah.
fundamental investing, usually there are so many parameters to evaluate. In trading systems, there are also many, but the key things are, I think one is win-loss ratio, like how much are you winning versus how many times do you win versus how many times you lose. So if you traded a pattern like the straddle on Thursdays over the last 5 years, say out of like 250 occasions, uh, uh, 150 occasions we won, 100 occasions we lost. Right? That's what data will show. And two is then when we won, how much we won on average versus when we lost, how much we lost. So these are key things which in Shakiru is an expert in this. So let him take it forward and talk about expectancy of the system.
Sure. See, but before that, no, definitely systems trading is not at all easy. Not only systems trading, no, being a no trader itself is very, very stressful. No, like, no, I even read an article like, no, the most stressful job in the world is, being a doctor in an emergency room. Like, no, they go through a lot of patients, critical patients. It's kind of a life-saving job for them. But still, the kind of stress these doctors go through is enormously high. And no, when they compare the same kind of brain movements with a trader, it's almost equal to a brand or surgeon on a emergency room. So it is definitely a very highly stressful job being a trader. But that is when these kind of systems trading helps. Systems trading just allows you to stick to the process and helps. But even with respect to systems trading, when there was this incident that happened in 2007, Jim Simons, who is we know everyone knows him, and like he's the best hedge fund analyst, and he's the one who manages Renaissance Technologies. He himself has gone through a rough phase between October or September 2007. That is when they call it as quant meltdown. Many, starting from AQR Capital, Renaissance Technologies, multiple quant funds has been losing millions of dollars every single day, all of a sudden. And nobody has any idea, starting from Citadel guys, JP Morgan guys, nobody were having any clue, because all of a sudden, whatever the strategies they were following, which was making millions of dollars, suddenly started losing monies in span of 3 or 4 days, losing millions of dollars. And what most these people done is they switched off their system, switched off their algos. They because they think this is completely out of sync with the market. There is something wrong. Probably we have to protect our capital, so they cut short it. And Jim Simons, on the other end, he was the last one to pull the trigger. Like, okay, this is enough. But we know that Jim Simons is the only person who doesn't hire any Wall Street guys. He doesn't hire any traders in his firm. So all the employees in his firm are basically astronauts, rocket scientists who specifically deals with data. And every single guy who is an employee of that fund were suggesting Jim Simons not to interfere with the system. Let the system take care of its job. But somehow, he interfered and he just closed the position. But within next 4 days, the system, whatever Jim Simons was following, eventually recovered from the losses. Not only recovered from the losses, it made huge profits. So being a system trader is still thing. You can be disciplined, but imagine a person like Jim Simons and all other quant guys who is managing millions of dollars are going through those kind of emotional imbalance. So
Yeah.
definitely that is there. It is not an easy task at all. But because the more money that you are dealing with, obviously the more stress it is. So coming to
Can
your
we say
question of evaluating what? Sorry, Vivek.
no? So I just want to add quickly, sorry to, but like, can we say risk management is more
Yeah,
important here,
exactly.
even
Yeah,
at a
right.
systemic level? How is the system losing or making money or losing?
Exactly. So, like it just helps us. Okay, even if there is multiple back-to-back losing streaks, we would be still able to take 11th straight, even after 10 losing streaks. So, as long as those risk management is inbuilt, some of the emotions could be controlled. So, in order to evaluating the systems, there is two things. So, if you are a manual trader, so the first thing that I would say is forget about all the parameters to evaluate the system. First, focus on the execution part, whether the system is really easy to execute for you if you're a manual trader. Consider you are trading with multiple indicators, multiple parameters, which which requires you to sit in front of a system between 9 o'clock to 3 o'clock and then take a trade from those signals, and it would be really difficult for you to take those trades. So if the execution is really difficult, but if the backtest is so beautiful, and if you're a manual trader, definitely you shouldn't opt for it. So you need to make sure
Right.
the execution is easier for you. And if you're a systemized trader and who wanted to evaluate a system, then I would go for terms like drawdowns to return ratio. Find out what is the overall drawdown with respect to overall returns. And the next thing is find out how many number of days you are going to be underwater. So there are some systems which would know, like for an example, trend following system. Most of the time it is going to be in underwater. Momentum systems, most of the time it is going to be in underwater. So find out what is the total number of days your system is going to be in underwater versus the total trading days. Say, suppose if your total, your trading system stays underwater or in a drawdown for a period of 100 days, where the overall trading days is 200 days, then divide this ratio and find out what is the ratio. So the lesser this ratio it is, much better for us to stick to that system. So eventually it is about the traders who is going to stick to the system. So we might find out the best backtest results, the best good results, but still if we are not able to stick to the system, we are not going to get the results. But the only way to get stick to the system is finding these ratios, whether the drawdown is lesser and the overall number of days that it is under drawdown is much lesser, then definitely we would be able to stick to the system.
Yeah, I totally agree. The ratios that you guys told, they can actually be the reliable, parameters with which you can evaluate a system and then build a successful system. Now, to take this back a little bit to in favor of our audience, which is learners in this field. I want you to talk about how long it has been for you, working in rule based trading, and how did you make that transition from discretionary to rule based. So a lot of our listeners here will be sort of looking to understand that from you, right? That if they do discretionary trading right now, how can they transition into rule based trading?
So I did, I think, discretionary trading for about 3 years. Luckily, it was around the time when Rakesh Jhunjhunwala report came out rare, and it's, I think, this whole, we are all indebted to him for life, in whatever ways he has inspired us, and he'll continue. His work will live forever. So there was actually a report where he's bullish on India, and I would buy stocks, and it worked, right, because of a bull run of 2004 to 2007. Then I got into derivative, and the FNO lure is very high because the returns look very good. And then the crash of 2008 came, right? And just before that, I got into derivatives from stocks without understanding too much about it, right? And lost money, like how everyone would go through. And then I read a lot. So I think a lot of books helped me, market wizards in particular. And within that, like Kirubakarans said, there's so many traders with different personalities. I think Ed Saikota's interview really struck a chord with me. And I moved into converting those rules into systems. Uh, Built a little bit in around 2012, traced it with a small amount of money, and luckily got friends family to support to kind of invest. And in 2012 December, there was an external investor who came in, who was ready to put some money, on which we ran the system. So it's now about 9 years. And the great thing was, 6 months, when the first 6 months when I ran the system, I had to do few things. Is A, stop watching TV and stop watching SGX Nifty and stop listening to an opinion of anyone for that trade. Right? That was a big transition. Those 6 months I had to just go to office, start that bot, right, and the system, and stop it at 3:30 and see the PNL and the feel the ups and downs of it, but don't react, don't intervene. And I think we are very lucky also that that phase was a great phase also. But I think that discipline element at the core level helped. And the first time in my life I saw that after making money, we are not giving it away. We are giving little, but still making, and the equity curve kept incrementing. And that was my kind of moment to transition to take up rule-based trading full time. And it's a continuous learning. It's a
Right.
continuous journey.
Yeah, I agree.
And no, I started in the trading, same as how Vivek started, getting into derivatives in 2008. It's the same case with me between 2007 to 2008. Whatever the stocks that we were buying, it was going up. And no, I remember buying stocks like Unitech at the price of 500 rupees and selling at 520 rupees. And almost for 2008 to 2014, it was completely a random trades because whatever the stocks that you see in the news or whatever things that you read in the newspaper, you get into a trade. And whenever you buy any put options or call options, you know, watch Dow Jones, how US market is performing. And again, you wake up early in the morning and see how the Asian markets is performing. And again, you see how SGX market is performing. And all these things happens when I am a no discretionary trader before becoming a rule-based trader. So this gave me a lot of pressure, or I don't want to be in that phase of constantly being in the markets. So in 2014, I read a book called How I Made $2 Million by Nicholas Darvas. So that was the first book that I read, get into markets, because that is kind of a storytelling book. It doesn't involve any jargons. So anyone who was getting started with the markets who do not know what needs to be done, it was kind of an eye opener to me, because that guy is just a stage performer who doesn't have no any backgrounds with the markets, who travels around the world, but he was able to make $2 million back in 1960s and 70s itself. That was not even like he has to get the news of whatever the stock prices through Telegram, not our Telegram app. It is just the actual Telegram. So he gets those news and he trades based on that, and he was able to make $2 million. When I read the book, then he says that he buys basically momentum stocks, where whenever stocks hits a 52-week high or all-time high, he buys that and trials that, and then when the trend ends, he exits. So it is such a simple set of rules which he follows, and he was able to make millions of dollars. Then it gave me huge conviction to get started with rule-based trading. So if a guy who do not know anything about markets could develop some rules and get into markets and make millions, definitely there is something that we could focus on this. And then that is how I get started with rule-based trading. So from 2014 onwards, it just gives you a sense of freedom. Like you don't need to make a lot of money to be a rule-based trader. You don't need to spend so much of time with the markets. That's all.
So one other thing for all the listeners, including all of us, if you see on Twitter only profitable screenshots, believe me, beyond a point, it's difficult to distinguish fake losing. If a trader is not losing, I mean, he or she is generally not genuine after a point. I mean, maybe, I don't know, but you have to be very careful about, everyone has losses. It's part of the business. It's part of the game.
Yeah,
Right?
right.
Definitely. It is just like the leftovers in a hotel. Like you can't expect every single food to get sold in a hotel. Like there will always be leftovers. So that is not a loss for them. It is just a part of business. So similarly, like losses are part of business with respect to trading.
Yeah, no, that's a good quote here. Now I wanted to, I mean, it's very interesting that even I started my journey in 2012. I think that's the time when a lot of algo traders have sort of started, and I very distinctly remember, the first trading system that I sort of worked on. The way it gave a profit, when you put in the hard work was such a big deal for me, right, back then. So, do you guys have a memory of your first trading system, and are you still running that system?
I'm really embarrassed to talk about it, because when you first get excited about all this rule-based trading, I started developing a system with 22 different parameters with every single indicators, starting from moving average to oscillators and everything, just to make sure that I end up getting a best backtest results. So eventually I was doing a curve fitting, but I did not know that what I was doing back then. So I created this system and it was giving beautiful results in the backtest. And I thought I'm going to be a millionaire with the system. I password protected the code with multiple passwords, and then I and then saved that file as a life changing AFL. Like I used to code it in Having Broker, so life changing AFL. And then eventually, what happened was the file name changed into version 1, version 2, version 10. And it was basically totally collapsed. Like the system did not take off, obviously, because it was a curve-fitted system, and that was a huge
Yeah.
learning. So obviously I couldn't trade the same system now, but now I don't use any indicators with my system. So most of the systems that I develop is completely based on price and volumes data. But
Oh,
that was my experience with my first trading system.
that's such a relatable story. I think our users will really appreciate that.
Yeah, I think thankfully after reading Market Wizards, I dropped any dreams of that millionaire thing without going through pain. Obviously, my image of first getting into algo trading was I saw this guy on a beach, like a cartoon or something, who's sitting and with a computer, and it's all just making money. So that kind of led me to get into it. But my first trading system was actually extremely simple. So I traded using a Donchian channel. Donchian is nothing but highest high and lowest low of past few bars, and developed by Sir Richard Donkin, who's known to be probably among the pioneer of systematic trading in 60s, right? And Ed Psychota kind of got inspired by Donkin and built some rules around it. He tested and he saw it works. So don't believe any one of us just because we say it, or anyone for that matter, because it's real money you're putting down the line. Test that, right? Like trust but verify. So test it out. If you find it works, tweak it a bit. If it works for you, then look at going ahead. So my system was very simple with a Donkin channel. When a highest high and lowest low is broken, they added to it a layer because it was too fast. There were too many trades. Then I added an exponential moving average rule to it. So now when my fast exponential moving average should be above the slow, right? Then whenever there's a document breakout above that, only then trade. So like maybe I'm getting a little bit of jargon and all, but if you're going to getting into systematic trading, then technical analysis, a little bit of that will be useful. And
Yeah.
there's a lot of material available. And I still trade a
Right.
version of it, but it's refined a lot over the last 7-8 years. But still trade the core
Right.
system that we built.
Great. Yeah. Yeah. So I think Kiru was right now mentioning that he was talking about trading on weekly expiry index options, right?
Yeah.
And but you can run the same strategy. I mean, the same strategy can theoretically run on all the symbols, right? So, what do you think that can one particular strategy work on all symbols out there and all scenarios? Is one strategy suited for everything?
Uh,
So, if you can, yeah.
Yeah, but running a strategy, a same set of strategies with multiple symbols would be really difficult because, each, say, suppose if you're, running a strategies on a basket of stocks, then each strategies or each stocks would be completely different. The movements would be completely different. For an example, consider, stocks like commodity-driven stocks, Hindustan Zinc or Tata Steel. No, any of these stocks are completely cyclical in movement. Based on the commodity prices, they could be trending, and sometimes they would be in a range bound. So, you say suppose because of commodity prices, last 5 years, Tata Steel has been trending. And then you take the last historical 5 years and see, okay, Tata Steel is a trending stock. Let me include that in my intraday strategy and run it. But the moment, the cyclical movement changes, obviously it could be in a range bound for the next few years. And similarly, if you apply, an oscillator indicator for an Reliance stock from 2008 or 2010 to 17, for 7 years, it was in a complete tight range. And after that, Reliance
Right.
started moving up and it moved up and it more than tripled. So applying a strategy with respect to a stocks, it cannot be a single set of stocks. You can't pick up a 10 or 20 single set of stocks based on historical move and then run a strategy over it. But what I would say is instead you can apply a momentum indicator. Don't have a list of prefixed stocks and then trade on it. Instead, you can apply a momentum indicator. I mean, not an indicator, momentum ranking mechanism. Say I wanted to trade stocks and apply a momentum ranking and find the weak stock and find the strong stocks, and then you can trade based on that. Then that helps because the ranking mechanism tells you to sort it based on the best stocks to the weak stocks, and accordingly we could go long on the strong stocks and go short on the weak stocks, and that could help when you're trading based on the stocks. So I
Right.
would say when you're applying a strategies on stocks, ranking mechanism, and then based on those filtered mechanism, apply a specific strategy that would help.
Okay. All right. So, I had another question here. I think Vivek was talking about these backtesting tools, and he mentioned a few different websites that that are good for options backtesting, right? So Vivek, if you would like to throw some light on how does one backtest a system, and what are the tools available for different types of backtesting that can be useful to the listeners.
Right. So let's just take an example of selling a system like selling a straddle at 9:20 a.m. It's very popular when
Mm-hmm.
market opens. We sell a straddle. So we are selling a call and put of the at the money strike. Right? So we say market opens, Bank Nifty opens at around 38,000. We sell a call and a put of 38,000. So what we
Okay.
are doing is we are we'll make money if market remains in a range, right?
Mm-hmm.
Like say we sold a straddle totally for 600 rupees, 300, 300. And
Right.
now the biggest thing is getting in is easy, but the what if the market trends, right? So what if it goes up or goes down beyond our expected range? This straddle will start losing money because one leg, the call, if it goes from 300 to say 800, the put goes
Mm-hmm.
from maybe 300 to 100, but the call goes up from 300 to 800, right? So we net lose. Now we want to put a stop loss to this, right? So if I'm on any leg, I sold it for 300, I want to put a stop loss of say 50%. So if the 300 call went to 450 or the 300 put went to 450, I want to get out, right? So I want to book out that leg and exit the trade. This kind of
Right.
rule we can make very easily now in a matter of 5 minutes or lesser, because the whole database inside of this is all available at the back of the tool, right? You put in the parameters without even knowing programming, we thankfully, and you can get a, just say run, right, what time you want to start, stop, and put a stop loss, and it will give you a
Right.
history of how the
Yeah.
equity curve of your system be. Equity curve, so example, you started with say a 2 lakh rupee capital, how that 2 lakh would have grown up and down, how many months you won, how many months you lost,
Okay.
and that's a good way to get started.
All right. So that's a perfect way, I think, to get started with backtesting. Now, I think Kiru was talking about curve fitting, right? So if you can throw a light on that and why it is bad, and how we can get over it.
Yeah, see, first, no, I'll try to explain what coverting and try and maybe in layman terms. Say, suppose, no, consider a guy who's going to, a wildlife to shoot, no, wildlife photography, and he goes to that wildlife
Hmm.
place, a deserted place, and he sees that, okay, this is the best place. Probably I should stay here for next 100 days to shoot, no, all these wildlife photographies. And he sits there and he tries to shoot, and then he decides, okay, let me build a shelter over it, and accordingly, so that I could stay here and complete my shoot for the rest of the next schedule. So based on his last few days or observation or whatever the people that he has interacted with about the places, he considers and concludes that this is almost a deserted place. It doesn't rain much, so probably just need to build a shelter which just doesn't need any concrete roof. You can just build a normal tent and can stay there and he can complete his shoot. And he decides that and
Right.
he puts a small tent and stays there and continues to shoot. And within next few days, it started raining heavily. So, no, whatever he considered that it was a deserted place, which in in last few days or whatever the recent observations he made, people he interacted with, nobody said that it is going to be raining, but it was raining so much that the complete area got flooded and his shelter was wiped out, and he couldn't stay there any longer. So this
Right.
is how curve fitting is like. We, based on our few recent observations or based on what we observe about the markets, we try to come up with our own conclusion. What this is, what it is, and try to build system based on that. Or else, based on you have a certain data and you want that data to give you the desired result. So you are not looking for the actual output, but you want the data to give you the desired result. So you keep tweaking the parameters and you keep
Yeah.
changing the parameters to get the desired output. Say, suppose, instead of 20 and 50 moving average, you tend to think, okay, probably 39 and 49 moving average would be good. 22 and 43 moving average would be good. So if you just optimize it, run an optimization, it's going to give you, this is the best moving average. But that is based on the historical data, like based on the historical movement, that is the best moving average. But that cannot be the same best moving average for the next couple of periods. So curve fitting is all about trying to get what you really want with respect to your data with so much of parameters, adding so much of optimization to get the desired result. So I would never ever recommend doing more optimizations with respect to any
So
trading
rather than
strategies.
just these best parameters, would we try to find a cluster of parameters or a region where it kind of
Yeah.
works, has worked best, so it
Exactly.
may work in future as well? Then,
Right. Right. No, I agree with you here. Now I have a very interesting question for both of you guys. If you can throw some light on it. That I understand that you guys were talking about momentum. You guys were talking about option based, dedicated type of strategies. All of these strategies move in different ways, right? So is there a benefit of combining multiple strategies to come up with a trading system? uh, do these correlated or non-correlated strategies add to the benefit? And when do you think is the right time to sort of stop one of the strategies? When do you say, "Ki, this one is done and let's move on"? So if you can throw some lights on that, that would be really useful.
so think I will probably take the part about correlation and the benefit. Um,
Hmm.
uh, Kiru, you may want to take about when to stop, because when so it's like this, right? Like you think of a cricket team, and if you had Sachin Tendulkar is the best player on the earth, right? Probably. If you had a team with all Sachin Tendulkars, would that be a good team?
Right.
Probably not, because every player goes through phases of ups and downs, right? and you want to have a diversified team. You want to have a portfolio of players, let us say, where there's a right hand, there's a left hand, there's a spinner, there's a fast bowler. So that whatever type
Yeah.
of pitch you get, sir, I hope the point is made. So in trading systems, if we are able to get a portfolio of strategies like a theta decay and a trend following a momentum, which Kiru said, the beauty is that we are able to probably have at least one of these system work 60-70% of the time, where either trend or decay, and there'll be some points where both don't work, right? So that's all. So then obviously the more and more systems we make, right, we can try to minimize that time where nothing works. But combining one trend following and one non-trending or theta decay system, as we spoke, is significantly better than running either a single trend following system or a only theta decay system, right? So there's
Right.
definitely a benefit. It's probably the only free lunch in finance, which is diversification.
Exactly. Like, no, answering to the question when to stop a trading strategy, it's like, no, there is no clear cut answer. Like, previously, when I started with systems trading, I thought, okay, if maximum historical drawdown is X, probably at 2X, I should stop it, or probably I should stop it
Yeah.
at 3X. But eventually, more I dig into the system and more I learn about the system, that is not the right way to stop it, because maximum drawdown is always in the future. So what we see in the historical drawdown, say suppose historical drawdown states that this is your historically maximum drawdown that you could see, that is based on how the index has performed on how the index has moved over the past. But indexes tend to move up over the future, and obviously the values tends to move up, and the stop loss values also increase. So what I would say is, if you are having a strategies, say suppose you know the profit and loss distribution of overall strategy. Say suppose you have 1,000 trades, you plot the 1,000 trades, and the 1,000 trades overall cumulative and overall drawdown will give you a graph. This is how the cumulative returns, this is how the drawdowns are. Similarly, the 1,000 trades, if you just rearrange it, randomize it, or run a Monte Carlo simulation, then you get to see 1,000 different graphs of cumulative returns and 1,000 different drawdowns. So basically, you
Yeah.
get profit, 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 loss, loss. When you randomize it, overall P&L changes. So when you run a Monte Carlo simulation and then find out over what would be the maximum worst case scenario that you could see, you will have an idea. Okay, historically my drawdown is X. Probably even 3.5x can also happen as per my Monte Carlo simulation. So the same 1,000 trades, but by rearranging the P&L, you are able to see, okay, this is the worst case scenario. Then you keep that worst case scenario in mind, and accordingly you create your money management rules on top of that, and decide what is the capital required to trade. And then if you trade that strategy, then you will not be in a surprise. So most people
Right.
tend to stop the strategy only because they see this is historical drawdown and it crossed. Now the system stopped working. I should stop using it. So that is a completely wrong way to approach stopping a system. And second thing
Right.
is,
Right.
any system can be in a drawdown for a prolonged period of time. So most people throw in the towel just because it stays underwater for a prolonged period of time. So time drawdown kills more traders than actually the money drawdown. So if we could
Right.
handle it,
Yeah.
so that is the only way, like as Vivek said, when you run an uncorrelated
Yeah.
systems, then these time drawdowns can be handled easily.
Right. Right. So we are, if you look at the YouTube stream right now, we are flooded by questions from the audience. So I'll move on to that. But before
Sure.
we move on to that, you can, if both of you guys can quickly, name a strategy, or simply define a strategy that is easy to follow and that somebody can quickly get started with.
So you want me to take? I'll take one strategy, very easy, which I've been using of
Yeah.
late. And
Yeah.
in fact, some users came back and said, "Sir, it's working a lot. We are making money." So I got
Mm.
more inspired. So it's dual RSI. Use two RSIs. So I use a RSI 5 and a RSI 13 period. That's 13 is the parameter and 5 is the parameter. So whenever RSI 13 is above 50 and the RSI 5 is above 70, go long. And I do this on an hourly candle in index, Nifty and Bank Nifty. And the exit rule for long is whenever the RSI 5 period, which is the faster period, goes below 55, get out. Just get out. So I use the RSI 13 as a decider level कि bullish जाना है या नहीं जाना है. If RSI 13 is
Yeah.
above 50, then I will look for RSI 5. If it's above 70, I buy. And below 55, I get out. Just one simple rule only for the long side. And for short
Yeah.
side, you could mirror this and try, but just try the long
All
side
right.
at the
Yeah.
start.
Kiru, you can quickly talk
Yeah,
about it?
I can share a strategy for options trading on specifically on expiry days. So most people
Hmm.
know who do a short strategy, they do it with a fixed stop loss, with a 30% or 40%. They just short both call option and put option of other many options on expiry day. Most people do it at 9:30 or 9:40, whatever the time. But the main issues that most people face is when they use a fixed stop loss on premium, it gets hit whenever there is a spike happens, or both their call option and put option gets hit and they lose. So in order to overcome that, what I have designed as a simple strategy is short both call option and put option, ATM call option and put option at 9:30. And instead of using a stop loss on premium, use a stop loss
Hmm.
on index level. Whenever index level moves beyond 1%, so when Bank Nifty spot moves more than 1%, or whenever Bank Nifty spot moves below 1%, say suppose if Bank Nifty is at 30,000 and you initiate a trade, a short straddle trade, and from 30,000, if it moves to 30,300 or
Hmm.
29,700, you exit both the call option and put option. Because
Right.
historically, during expiry days, the number of days that market stays in range bound within 1% is much higher. So this strategy works specifically on expiry days more. And whenever it trends
Okay.
more than 1%, you're closing with a minor loss. So short straddle strategy with 1% stop loss on index levels is a better
Yeah.
alternative.
Yeah, so two excellent strategies are users. You guys should go back and actually look at what these guys said. These will be two very interesting things for you to implement. Now we will quickly move on to the audience Q&A. We have quite a few questions, so we'll have to be quick. We have just 10 to 15 minutes to answer these. Uh, so first question that I have here is from our audience is that how do I decide if system or discretion is suitable for me, right?
Try it
That he
out.
has to decide. He has to
Yeah.
try them, then he has to see.
All right. So now somebody is asking that index prices and the option price charts are not in sync, right? That's what they're observing. So how can I place a stop loss based on the index levels for my options trade? So
So
what would
based on
you be?
index level, we can't directly place a stop loss. What you can do is you can set an alerts, like you can use multiple
Hmm.
free tool alerts where whenever index crosses this, send me an alert. Free tools are there. Based on that, you can send an alert to yourself, to your mobile or to your app. So when
Hmm.
that is hit, you can manually close your positions. So that is the only way to manage it. Otherwise, you have to do it through algo trading or through systemized trading.
Got it. So Vivek, would you like to answer that? Is price action enough for trading, or is something else that we have to
It's
look
the
at?
holy grail. They say Bhav Bhagwan che in a Gujarati, there is a thing like price is God. Price action, it's all the information needed discounts. And again, the thing is, even if someone knows something I don't know, right, and it reflects in price, someone may say something, but his or her action is reflected in price, right? So if price is against me, I'm out. If it's in favor, I'm in. That's all.
Right. Okay, now I have a very interesting question, and I'd like to see you guys answer this. That somebody is asking that why are there so many ups and downs in the market? What is the reason behind it? And this didn't happen in COVID-19, so why is this happening now?
So I know we've been here for a few years now, and we're still learning. But the last couple of years, I think market has probably changed after COVID. In a way, there's a probably
Yeah,
we call sometimes like a regime. It was something none of us, our grandfathers, forefathers, would also not have seen. So the pace of volatility inside the market intraday has changed, and we are all
hmm,
seeing it. And there's a good thing and a bad thing here. The good thing is some of the systems which weren't working too well in next. I was just
hmm,
listening to somebody who trades US global markets significantly since years. Started saying some systems have started working now, volatility based system. So volatility for a trader is a friend only if you can have discipline, risk management, money management, and use it as a process. It's a friend. And
right,
the bad thing is sometimes it can hurt, like Piru said, that spike comes. So like diversifying across systems instead of just a percentage of stop on the premium, use the
right.
underlying different
Yeah,
mechanism. You have to figure it out, man. You have to like keep trying and see what works, and like see what works for you and how the market is behaving. Like keep trying.
all right. Yeah. So Kiru, somebody is asking for a strategy to trade Bank Nifty for a better income. So will you like to give a simple strategy for them to follow?
Yeah, the whatever the strategy that we discussed right now, right? So that strategy
Yeah.
is specifically designed for Bank Nifty. So based on the historical data sets on how the Bank Nifty behaved, especially on expiry
Hmm.
days, we studied that strategy and created it. So people
Yeah.
can just rewind to what we have discussed, and then if they could know, just go to
Yeah.
the whatever
Definitely.
the strategy details, that would help them out.
Yeah. Yeah. Now I have another very interesting question that gap ups and gap downs are the biggest enemies for traders, right? And they scare us. So how do you handle that?
We trade only intraday, so so we avoid the gaps.
Yeah,
Okay.
so I still trade a positional system, the stock system, which I said, the breakout one. And obviously, the volume of that has reduced over the years because there's more and more
Huh.
intraday activity. But I'd say if you're trading positional, one way is you trade a portfolio. Since you're just one, two stocks, you need 20, 15, 20 stock. Obviously, capital required will go more there if you're doing it.
Yeah.
Otherwise, don't trade stocks, just avoid. And in index, in the positional system, I said the breakout one on hourly, right? You can buy a call option instead of taking a future. So with when you buy a call option, you know that whatever happens on the earth, even if there's an earthquake, you will not lose more than the premium you're paying, right? And if that premium is just 2-3% of your overall capital you're using to trade, you know that one trade, two trade, even three trade in a row should not kick you out of the game. So
Right. Right.
use the future signal and buy a call or a put, right? Like if you want to go long, buy call. If you want to go short, buy put. That's a great way I think I use to curb the overnight risk or nearly
Right.
minimize that.
Right. So, Vivek, you also talked about simple backtesting strategy, right, and how people can do backtesting. Somebody is asking, then let's say I have more than one signals. I have two, three indicators that I want to work on a backtest with. Then how do I do that?
So with indicators, just advices, just think of it like you have a pipe, right, where water is flowing. An indicator is like nothing but a valve. I'm not getting technical or whatever, but very simple word which is going to control the flow of water. If you have less of valve, a lot of water will flow, right? If you have a bigger size valve, very little water will flow. Your indicators are like just should be about right to get as much water to flow as much as what you want, right? So same way you put
Right.
as many as you want trades to flow. Just think your indicators are like the valve you're making, and the trades are the flow, right? So tweak it and try it, and try to use indicators which have different purposes. If you're using all momentum indicators, they may not serve. But if you're using
Right.
one for say momentum and one for strength of the momentum, like ADX is an indicator to determine whether the market is strongly trending or not, then they may serve a purpose.
All right. So now I have a very interesting question that how do I know if my backtest is over optimized or if it is a good strategy? My answer to
So
this
the
would be if your backtest is doing really well, then it is over optimized. I would like.
yeah,
More
see,
often than not. I mean, you want to first
yeah,
get to really
whenever we are
stupid.
whenever we are developing a no system, the first thing that we see is if it is really, really good, then that's all. We go bad or something is wrong with the system.
I call
Definitely,
this
I
like
can't believe.
castles in
Yeah.
the air. Whenever it looks great, I have this island of what I'm going to have this castle, and then that just gets shot down. Like, right?
So in order to
All
decide
right.
whether it is over optimized or not, you can decide. Like for an example, what most people do is if with a normal short straddle or an option selling system is they use day wise filters and change stop loss and entry times. Say suppose you are an intraday trader who are trading a short straddle strategy, and you are entering 9:30 on Monday, and the Tuesday you're entering at 10:30, and you keep changing the entry time and exit time. You keep changing the stop loss based on day wise because that is going to give you the best results in backtest. So I've seen most people doing that because if you just apply a normal entry time and a normal stop loss throughout all days, you get no return, say suppose 5 lakhs. But if you keep changing all these parameters, say suppose you're getting 10 lakhs, then you feel excited because you thought that you found the best parameters and that is going to give you the best results. But this is what curve fitting is. So based on
Right.
those previous data, if you keep changing all those multiple parameters, then that can give you best practice results. But that is what curve fitting is. So you might be over optimize the system.
All right. So somebody is asking here that they trade on pivot points and news. So do you think that is a good strategy?
See, anything that works for you. Technically speaking, we are not here to advocate a particular type of system or a trade, right? Mechanism, right? Whatever works for you. What you may want to do is use a rule-based framework to minimize risk and continue to use. But if you're using news, if you're building, if it works with a mix, some people also use a system plus some discretion, right? So you could use a system to give you alerts when it's probably going on,
Right.
or if there's extreme news and you don't want to participate, stay away, right?
Yeah.
In the start it was said, don't trade necessarily if you don't have to kind of just take a break or travel, right? Like just go out and enjoy or spend good time with your friends and family, right? So there are
Right.
ways you
So
can do
basically,
Right.
whatever
So,
the system it is, basically, if it gives you a good sleep, then you're actually trading a good strategy.
that's a perfect example here. Now, I have a final question for you guys, and then we can conclude. People are asking you that how do I decide the time frame for trading options and the strikes for trading options, right? So, we'll end with this question. If you can throw some light on this for our users.
Yeah, basically using a strikes, you have to study about the strikes, like how ATM option behaves, how OTM option behaves. Specifically on expiry days, the more time you spend with the open positions, like if your position is open from 9 o'clock to 3 o'clock, the more the time, the more the money, because it is going working. It will be working in favor of you with respect to any kind of strikes. So you need to decide whether what kind of strategy that you basically create, and based on when you're going to. So the nearer to the expiry, the faster the decay is going to be. So you can't run an
Right.
option buying system on an expiry day. That can give you positive results, but you need to take 8 losses out of 10 trades. So are you okay with that? So you need to find out what kind of systems that you're deploying or developing, and see whether how the system would behave, whether near to the expiry on expiry days, and
Right.
accordingly you have to choose a strike.
All right. So I think this was a really informative session. I think a lot of people who are looking to move from discretionary trading to rule based trading, becoming more disciplined, learn from experts like you would have gained a lot from you. Thank you, everyone. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.